Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
All right, happy Sunday. We're coming to you every single week because we want to give you sincere and actionable ideas, the type of ideas that you can use to improve the lives of yourself and your loved ones financially, because it's not about surviving retirement. We want you to thrive in retirement. And most of all, if you're going to get retired, I just care that you are able to stay retired. And that means putting some stuff in perspective. Seriously, putting stuff into perspective. Let's talk about separating short-term versus long-term views right now. I acknowledge this. There has been some chaotic execution of trade and tariff policies from the White House. And what it's done is it's starting to hurt consumer and business sentiment. I didn't say data. I said consumer and business sentiment. Sentiment is how people feel. And as a result of that, the market's in a worry that this feeling or this sentiment that people have from some of the chaotic execution of the trade and tariff policies could actually create a change in behavior. And that change in behavior could be a slowdown in business spending if business owners feel less certain. It could be a slowdown in consumer spending if just the negative headline in the mainstream media keeps it in our face. And practically speaking, that would be a problem because a slowdown in spending would create a slowdown in earnings per share. But all of that is stuff that's possible. It's not yet probable, okay? It's not yet probable. So the policy chaos, it's caused near-term market outlook to dim, and substantially. I mean, we just engineered a 10% correction from top to bottom in broad market indices. But again, we have to keep perspective because 10% market corrections happen every 12 to 14 months in otherwise healthy bull markets. And remember, we talked before that these bull markets that last at least 2 years, because not all bull markets make it to the 2-year anniversary. This market we're in right now has endured 2 years of growth. Once you get to the third year, which is the year we're currently in, it tends to be the weakest of the 4 to 5 year pattern. So there could be plenty of economic growth, plenty of stock market appreciation to come. But if history's our guide and it's the only guide we have to pay year 3 through sluggish growth. So understand the policy chaos, and it is chaos, has caused this near-term market sentiment to really sour. And up until the markets can understand what the ultimate goal of the tariff/trade strategy is, then any short-term rally is likely to be temporary, and it could be an opportunity for those that feel they need to de-risk. So again, I say that clearly. Until the markets understand what the ultimate goal is of the tariff and trade strategy, any short-term rally, which we will get because you always do, might be that opportunity for people to reassess what they're doing. So here's my point. We're talking about the tariffs. We're talking about Trump. We're talking about your 401k, your IRA, your investment portfolio. And my point being this morning, it's not even the actual tariffs. No, the actual tariffs aren't the problem. It's the apparently random and volatile nature through which the tariffs are being applied and then being removed and then partially being applied and then partially being re-removed and then they're threatened and then they're unthreatened. That's the main issue. And until that goes away, the best we can hope for in this market is that it hangs around in these current levels, the levels we're kind of in, the normal levels you get to when you have a 10% correction. But here's what I want you to be thinking about. We're talking about Trump, tariffs, your portfolio, what's happening. While the near-term outlook might be dim, I'd be hesitant, seriously hesitant to extrapolate the near-term outlook into a longer-term view. And I want people to know why. This is fact, not fiction. First, there are policy positives looming in the future. There are tax cuts that will likely be extended and potentially increase growth. That puts a tailwind at consumers' backs. Second, beyond the policy positive of tax cuts that's likely going to happen this year, a renewal of the Tax Cut and Jobs Act, you get deregulation. I mean, deregulation's ongoing right now. It's just not front page on the headlines. I mean, there's a great strategy besides us at VestGen, a guy named David Zedros. He said, he's one of the other great ones out there, that deregulation is one of the most powerful pro-business moves an administration can make. And this administration is about deregulation. Pro-business. Third, you got the Fed put. The Fed put's alive. The Fed put is alive and well. And if it wasn't for the tariff chaos that's happening right now, I think the Fed put would be much more supportive of stocks. And keep in mind what we got this week. We learned that CPI, Consumer Price Index, year over year, guess what? It's down to 2.8% from 2.9 year over year. We learned this week that PPI, the Producer Price Index, also went down. So the good news is the inflation is still heading lower. That gives the Fed room to eventually cut rates later this year. So beyond the positives that are there is going to be a likely tax cut, a renewal of the Tax Cut and Jobs Act. There is going to continue to be deregulation. You have to look at the fact that the Fed put, that Federal Reserve backstop, is alive and well, because we will get some cuts. There's a fourth thing that doesn't get talked about. There are some senior levels of the Trump administration that are staffed with successful people who spent their lives in economy and markets, not the type of people who lived in the world of academia. These are not political appointments. These are wicked, smart people like Howard Lutnick and Scott Bessent. And these guys, they understand markets. They understand the economy. It would be next to impossible to think that these two Wall Street titans don't get it. So what's the bottom line? You bring all this together, as we've been talking about Trump and tariffs and the fears that are out there in the near term. This market needs some consistency in policy rhetoric to stop the decline. And up until investors believe that they understand the point of the tariffs, and specifically, we're talking about what's on mostly Mexico, Canada, because the market understands. The market understands the point of Chinese tariffs. We do. I mean, in fact, people would argue the tariffs that we put in place during Trump 1.0 were actually good. Because did you know that 21% of all the components we bring in the United States of America to assemble goods and services, 21% of them were coming from China? Well, that was where we were 6-7 years ago. Now, in our current state, only 14% of the components we bring into the U.S. are for China. Why? The tariffs caused business leaders to onshore some of that production in America so they didn't have to get the parts from China. The tariffs on China back then called business leaders to go ahead and nearshore, meaning start bringing components from other countries closer to the United States. That's good because that's a security thing, right? So the tariffs on China, get it. The tariffs on Mexico and Canada, fair trade, we all want it, but we just need some clarity. But if you said, what does this really feel like? I got to tell you, it feels much more like the normal correction that we have, as opposed to feeling and looking like something that is other than a garden variety correction. Now, that is not meant to inspire hope. That is not meant to have you stay calm and retire on. That is meant to say factual data because I've yet to see a recession happen when we have an unemployment rate of 4.1%. I've yet to see a recession happen when we're creating 151,000 jobs per month, 49 consecutive months in a row. I've yet to see a recession without widespread earnings cuts. I've yet to see a recession without widespread consumer slowdown. So the point of this is, use this as a professional pause. Use this as an opportunity to revisit your portfolio strategies. Use this as a wake-up call to not be complacent, but to get educated, to get informed, to get empowered, because you too might want to benefit from strategies that are TNT, strategies that are tested in the trenches. And at VestGen Wealth Partners, the firm I co-founded, Craig Bolanos, we are a family office for everybody. We are the registered investment advisor on a fiduciary standard. We do better when our clients do better. We do all of our financial planning under that CFP standard of care, along with the cash flow modeling, because retirement's not about assets. Retirement is often and always about cash flow. Part number 3, we recognize that everyone's single largest expense is TIR, taxes in retirement. And we are chock full of robust strategies and CPA to help you navigate taxes in retirement. And don't forget, the last part of the equation, estate planning, which includes long-term care and retiree health care. We can solve for all of those under one roof. If you want to learn more, you absolutely can and should. 833-964-PLAN. 833-964-PLAN. Check us out online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Okay, more to come. Important news you can't afford to miss, including annuity mistakes I am seeing people make in today's marketplace. You're listening to In the Know. Craig Bolanos, VestGen Wealth Partners, AM 560, The Answer.
In the Know Radio with Craig Bolanos on AM 560, The Answer, where his goal is to pummel you with financial know-how until you say uncle.
You know, we talk about these 3 pillars of retirement income. Capital matters, capital matters, capital matters. Once you get retired, you need to make sure you have a plan not to take a major hit. In addition to that, we talk about generating sufficient portfolio income. That's interest, dividends, distributions, annuity payments to make sure that you don't touch the corpus. And then finally, grow your capital balance so that you can grow your income and outpace inflation. But annuities are a part of that for a lot of people. Not everybody needs an annuity. Not everyone should even consider an annuity. But I know from the platform of this radio station, there's a lot of people who have bought a lot of annuities because people want some level of guaranteed income. And if that's you, listen, because I want to give you some of the annuity mistakes you need to avoid, because I want you to avoid them. And the first thing is, please do not think an annuity is your retirement plan. There are too many people selling you annuities that are shiny objects. If it sounds too good to be true, it probably is. Remember, an annuity should be nothing more than a guarantee. That's a guarantee against loss and a guaranteed stream of income. That's the benefit of an annuity. So what I see a lot of people doing is they're getting or purchasing from a salesperson the wrong type of annuity. Remember, there's no one size fits all when it comes to annuities, and choosing the wrong one is going to leave you fraught with regret. There are fixed annuities, there are variable annuities, there are indexed annuities, there are immediate annuities, there are deferred annuities, qualified longevity annuities. There's so many different types. And what I think about in this market is there's a couple of things that resonate with people. Number one, if you want to keep it simple, if you just say to yourself, hey, I want a 3-year or a 5-year guarantee, you can go out and get a 3-year or a 5-year guaranteed interest rate at 5%. Simple. That's a fixed annuity. If you have interest in just locking in 5% on a part of your money, go ahead, pick up the phone, call us, 833-964-PLAN, 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. Let's just go get a fixed annuity paying 5% for 3 to 5 years, call it a day. The next type of annuity that a lot of people are using is a fixed indexed annuity. A fixed index annuity is the type of annuity that allows you to participate in a portion of a stock market's gain without ever experiencing the loss. What do I mean by that? You're going to participate in a stock index crediting method like the S&P 500 up to a cap, right? So you can make money up to that cap. So if the stock market has a huge gain, you're only going to make up to the cap. If the stock market has any loss of any kind, you lose nothing. That's kind of the next rung on the ladder that you can look towards. And if you want to learn more, you can. 833-964-PLAN. But here's what I don't want you to do. I don't want you to buy a fixed index annuity that gives you some kind of a bonus. You don't need a bonus. A bonus is meant to distract you. A bonus is meant to say to you, the would-be purchaser, oh, we're going to give you free money. There's no free money. You don't want to tie your money up into an annuity for 10, 12, 14, 17 years. You don't want to tie your beneficiary into a payout that has to go 5 years. You don't want to do anything like that. If you're going to buy an annuity, keep it short term, keep it incredibly simple, and settle for something like a 3-year or 5-year 5% guaranteed rate of return, or settle for a very simple fixed indexed annuity with a cap to allow you to participate in markets without experiencing a single day of the decline. That's what we mean by choosing the right product type. And then again, my next thing is too many people are glossing over the details. And the reason people gloss over the details is I think some of these sales agents who are selling these things at libraries on this radio station or others, they don't even know the details themselves. They haven't even read the details themselves. The commissions, the administrative fees, the surrender charges, the riders. Again, work with someone who's going to keep it simple. Someone who is going to put your family's interest first. Someone who doesn't put their firm's revenue ahead of yours. That's why you need simple strategies. Next piece, make sure you're shopping. You can't just look at one opportunity. A good advisor is going to bring you all of the opportunities. We literally put them all on the computer screen in real time so you can see what we're seeing so that you can ensure we're being objective and getting you the highest interest rate, the highest cap rate for the shortest commitments of time, because that's what needs to happen. And then, above all else, don't overpurchase. An annuity is a tool for a portion of your money. It is not a solution for the majority of your money. It is not a solution for all of your money. It is a solution for a portion of your money. And I'm talking about this because there is fear, there is sentiment, there is confusion out there, and there are people flocking to annuities. And I'm not saying don't flock to an annuity. I'm saying if you want an annuity, let's make sure you make a very measured, intentional decision and work with an advisor that is independent, open architecture, objective, that can help you look at all of the solutions and find one that is not a shiny object, find one that is simply effective, because this is about IQ, not just intelligent quotient, it's about implementation quotient. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. Well, as we're talking about annuities, what if you already own an annuity? Seriously, it may be time for an annuity refresh. What's an annuity refresh? If you think about what drives an annuity's payment, it's mortality, the age that you are at the time you buy the annuity. It's interest rates, in effect at the time you buy the annuity. And for people who bought annuities, older annuities, just anything before 2023, there's a good chance that your interest rates, your cap rates, your payment rates are less than that through which you could get in upgrading to an annuity today. Why is that? Because interest rates are higher today than they were at any other time in recent memory. I mean, remember getting mortgages for less than 3%? Remember earning 0% in the bank? Remember 0-point financing on a car loan? All these things, those days are gone. So with higher interest rates today, it's a great time to look at doing an annuity refresh because, again, if you purchased your annuity prior to 2023, there's a great chance that you can refresh and replace that annuity with one that has better terms and conditions. But of course, you can only do that if you bought a good annuity that doesn't tie you up for 10, 12, 14, 15 years. Part number two, some of the annuities in the marketplace today might just suit you better. Why? Because your objectives on what you're trying to achieve has probably been modified. Next piece, I encourage you to really think through income taxation, annuity location, and where that all is. So here's my walkaway message in this segment. If you are interested in buying an annuity, keep it super simple. An annuity is a tool for guaranteed income, guaranteed interest. It's a low risk investment. Settle for a simple multi-year guaranteed annuity of 5% locking in for a 3 or a 5 year period. Or choose a dirt cheap, stripped down, low cost fixed index annuity without any bells and whistles that allows you to participate in a crediting strategy tied to a market index up to a cap without the risk of loss. That's it. That's it. And if you have an existing annuity contract today, especially something you bought prior to 2023, you owe it to yourself to do an annuity refresh while interest rates are higher to see if you can replace or improve upon the terms and conditions that you currently have, because I think it's last call. I think we just got this week lower inflation data on consumer price indexes, lower inflation data again on producer price indexes, and that means later this year, the Fed is going to go back to rate cutting. 833-964-PLAN. 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. Let's help you do an annuity refresh, or annuity research to ensure that you're making the best choices based on your situation. Okay, when we come back, if you have been wondering how to make sure you thread that needle between publicly traded stock, publicly traded bonds, and private markets, I'm going to talk about it again. If you're looking on how to build portfolios that have permanence and definition, we're going to go over that again too, because I think it's important at this day and time. More to come. In the Know, AM 560.
More in the Know Radio. You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
So our theme for 2025 has been one of pragmatic optimism. That's what we talked about all through January, is pragmatic optimism. And part of pragmatic optimism means we also want to implement that pragmatic optimism by diversifying our diversifiers. I know that's a play on word, diversifying our diversifiers, but boy, that makes sense. And what that means is taking a look at what I call some hybrid type investments, things that sit in between normal stocks and normal bonds. we're going to talk right now again about preferred securities, which once again are off to a great start. And why wouldn't they be? Because preferred securities offer preferred stock, offers generous yields, both absolute and after tax. And when you've got that higher income stream, it serves as a total return buffer against VIX, which is market volatility. So here's the things you need to know. Number one, preferred stock, preferred securities, it is again a hybrid security. Why is it a hybrid? Things are sometimes classified either as equity or debt, stock or bond, within a company's capital structure. But preferreds are senior to common stock, but junior to bonds. As such, preferred securities don't have the capital appreciation potential of common stock, but they do possess some of the same capital preservation benefits that you would expect in a bond. That's why I call them hybrid. And preferreds, by the way, have more of a financial focus. A majority of the issuance that's out there comes from financial institutions. And why would you care about that? Because deregulation is primarily going to be helping the financial sector, and finance has a tailwind at its back. That helps preferreds. Next, you got to think about there's multiple markets. There's retail preferreds, there's institutional preferreds. I don't want to get lost in the weeds, but when you have a hybrid security that has these components, it can give you great diversification benefits, but people need help executing, because I think it's ideal to be working in a space of both what I call the institutional $1,000 preferreds and the sometimes irrational, which means there's an opportunity, retail preferreds at $25. So if you want to learn how to start generating larger yields for cash flow, both on an absolute and an after-tax basis, and you want some buffer against volatility from the equity side of your portfolio, I think preferred securities are a great way to look to get that done. Give us a call, 833-964-PLAN. That's 833-964-PLAN. Connect with us online, getretiredstayretired.com. All right, another security that kind of fits in there is the world of private credit. Oh, I know you're like, Craig, you've been talking about this for months now. Yeah, I have. Because when the stock market trades at 21 to 22 forward times earnings, that doesn't mean stocks are set for a crash. It just means the outlook for future growth of stocks probably isn't as robust as it was for the last 2 years. That's what valuation tells you. So what would be wrong with taking some paper profits from 23 or 2024 and repurposing those paper profits into another security that I deem private credit, which is where you're making loans through a fund to corporations. They're primarily floating rate loans. They're loans that are primarily in the first lien position, where you have return profiles intermediate to long-term of 7 to 9%. Because if you're looking to generate high income, and high income after taxes get paid, well, preferred securities and private credit, both of them absolutely fit the bill. And I think people can and should be investing. I think the next spot that people talk about in this search for yield, this search for income, securities that go in between, you've heard me talk about data centers are the new gold. You've heard me talk about the power consumption it's going to take to have data centers. You've heard me brag about the fact the U.S. has more data centers than the next 10 countries combined. Why do we have that? Because we have energy independence. It takes massive power. But if generative AI is here to stay, oh, by the way, it is, then you're going to continue to see public tax dollars and private partnerships coming together to make sure that we have energy, both in this country and abroad, in large part, not just for domestic security, but to power data centers, because he or she who control the data centers is going to have an inside lane on economic growth for years to come. and the U.S. is already there. And the U.S. recognizes this. There's a reason we're no longer exporting like we used to some of those generative AI chips to create threats and competitors like China's DeepSeek. Thankfully, that's cut off. But we have to look at this as an investment theme. How do we generate what could be, again, 6 to 8% returns by making passive income investments in things like infrastructure? It's just a different way. Instead of having publicly traded stock, publicly traded bonds, why not be a passive income investor by physically being an owner of various forms of real estate in the infrastructure space? Liquefied natural gas terminals. We can talk about all the different ways to do it, but if you want to learn more, you can. 833-964-PLAN. That's 833-964-PLAN. Or go to our website, getretiredstayretired.com. In fact, when you're on that website, you know what? Spend some time. Download some of our free publications and guides. Take a look at all of the media we do, not just the radio. I mean, look at all the TV we do. And why do I say that? I say that because I want you to see who we are. It's authentic. We are the same group on the radio that we are in the conference room, that we are in real life. Because when I say people need sincere and actionable ideas to get retired and stay retired, that is not a sensationalized statement. That is an authentic statement that is driven by data, because when you make decisions that are systematically repeatable processes that have been tested in the trenches through the measurement of data, it leads to a more consistent result, because you can't make decisions with your retirement off of suspicions. No, I suspect this. That's not a good place. Follow the data and be measured and intentional in everything that you do. And that's one of the hallmarks and consistencies of how to win. But it also is a hallmark of what we've developed at the company, because that family office concept, being able to access multi-disciplines, tax, healthcare, long-term care, cash flow modeling, budgeting, registered investment advisor, goals-based financial planning, putting all of that under one umbrella that doesn't have to be outsourced and referred out is what allows people to have the opportunity to have deeper conversations that are more proactive, because we believe that the more educated somebody is, the more empowered they are to understand what they own, why they own it, how it works, which in turn allows people to sleep at night better. And when you sleep at night better, that means you worry less and you have an opportunity to live more, which means then you could ultimately enjoy the fruits of what you've worked an entire lifetime to create. If that resonates with you, that's us. That's the team I lead. 833-964-PLAN, 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. All right, when we come back, I'm going to talk to you about how to properly add treasuries, notes, corporates, the right way to do bonds in your portfolio to generate that income that everybody wants in retirement. In the Know, AM 560, The Answer.
Of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
All right, I want to talk a little bit about the right way to do permanence and definition in your portfolio, and that means buying bonds, right? Because everyone talks about stocks, everyone talks about products. Let's talk about bonds and fixed income. Part number one, there is no bond exchange, right? Bonds trade by dealers. Hence, you got to pay attention to the Costco effect. You need to make sure you have economies of scale when you're buying bonds, because you don't want to be subject to markups on the price that you'll never even know exist. That means you need to work with great financial advisors who have multiple fixed income desks to help ensure you get the pricing. Guess who has that? We do. Part number 2, you don't want to only own bond funds. You need to make sure you own bond funds that have a known maturity date, aka the fund. If you want a fund for instant diversification, it needs to say on it 2027 or 2030 or 2032, because that means the bonds in the fund are going to mature in 2027, 2 years from now, or 2030, 5 years from now. And what that can give you is what the value of the fund is going to be. You know when you're getting your money back because you know on what date the bonds are going to mature. And when you know the maturity date, which means you know when you're getting your money back, you also can calculate what yield to maturity is. And isn't it nice to have certainty? So if you want to build a bond portfolio today that matures between 2027 and 2032, like a corporate bond ladder, you can build a corporate bond ladder today of various credits. If you're willing to sprinkle in a tiny bit of high yield, right? 15%, you can achieve yields of 5.48% yield to worst, 5.5% yields to maturity. So if you want some safe money, you want to create some permanence and definition, you can create bond ladders with defined maturities that can generate you internal rates of return. Think of it as APR of 5.5% for the life of those bonds. You know what? That's not going to create wealth. But if you have an inflation rate running under 3% now, and your money's earning 5.5%, guess what? You're not going to have any problems. It's that simple. If you're taking a sustainable withdrawal rate from your portfolio of 4%, but you're earning 5.5%, you don't have any problems, right? So this is what I want to drive home. So in addition to building a bond portfolio correctly, making sure it's a combination of perpetual plus defined maturity bond funds, I encourage people to keep it simple and work with an advisor who can help you roll individual treasuries. Individual treasuries aren't as great as they once were. But if you're cash flowing, I didn't say investing for safety, but you're cash flowing. What's wrong with literally building individual treasury bonds so that you've got money maturing in April and then maturing in May and maturing in June and maturing in July? And what does that represent? That represents your cash flow reserve bucket. You've got individual treasuries maturing every single month that are equal to your retirement spending. And does anyone worry about the United States of America going out of business? No, I feel very comfortable owning a treasury bill backed by the full faith and credit of the United States of America. And I like the fact that I can look at my statement and see, oh, my retirement income, it's coming from the treasury that matures in April. And then it's coming from the treasury that matures in May. And then it's coming from the treasury that matures in June. You can have all those things built out. There's different ways to do it for different folks. The point is, it takes a team. You can't hire a single advisor who simply has one or two support staff if you want to do things well, because it takes people full-time dedicated to their craft to sit in front of the computer and roll treasuries. It takes people full-time dedicated to their craft to make placements of hybrid securities like preferred securities, private credit, real estate, like we mentioned. It takes different people as a full-time job to execute these things. And that's why we've assembled a team, because everybody has their role, because your retirement can't be reliant upon a person. You need a belt and suspenders approach, right? Because you got to make sure the pants don't come off your retirement plan. And that means you don't want it driven by a single person. So if you're still working, with a single advisor model, who watches your money while your advisor's on vacation? Who's attending to the money when your advisor gets sick? In that single advisor model, how can your advisor actually be managing the money? No, that advisor is typically just reporting on how the money's being managed by somebody else. No, you deserve to sit across the table from the people who actually make the decisions, who are actually responsible for owning the results. That's what we do, and we do it very well. And if you want to start having conversations that are refreshing like that, pick up the phone and give me a call. 833-964-PLAN. That's 833-964-PLAN. I encourage you to go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. And when you're on that website, take a look at all of our media, because I want you to be comfortable with our voice. See the consistency and authenticity of that voice through all of the TV work that we do. In addition, take advantage of that complimentary consultation. I will make sure that I visit with you myself, especially when you come from this radio station, because people who are listening to Salem, AM 560 in particular, we have commonality. And I want to respect that commonality because it's nice to work with like-minded individuals. 833-964-PLAN. Go out to our website, getretiredstayretired.com. All right, so here's some themes that we talked about today. The data suggests that the economy is on solid footing. The sentiment, though, is negative. There's no doubt. The whole problem we have is the chaos over trade right now. At some point, I do think that that too shall pass. And assuming we're still having job creation, we're still having consumer spending, assuming we're continuing to see CPI and PPI, those are the measures of inflation that go down, we just have to accept that in that typical bull market cycle, this is the sluggish year out of the pattern. So doesn't it make sense then that we fulfill our portfolios with other things because we're pragmatically optimistic? So we're going to diversify our diversifiers. Let's look at preferred stock. Let's look at private credit. Let's look at passive income with the correct form of real estate, infrastructure, warehousing. Previous episodes, I've talked about cap and cushion. Today, we talked about the right type of annuities if you want a simple 5% guaranteed interest rate. We also talked about how to get 5.5% from bonds. We talked about simple, non-shiny object, fixed index annuities. Participate in a market crediting strategy to a cap without experiencing any loss. None of those are one and done. Those are just different tools that people can use if they want to diversify their diversifiers, meaning own more than just stocks and bonds. If that resonates with you, and I hope it does, connect with me. I'm Craig Bolanos, co-founder, VestGen Wealth Partners. We're a family office for everyone. It's a multidisciplinary firm: investments, financial planning, estate, retiree healthcare, long-term care, income taxes, and we want to show you the VestGen difference. More to come. In the Know, AM 560, The Answer.
Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560, The Answer.
So we talked about diversifying our diversifiers. That pragmatic optimism is a theme for 2025. Well, let's talk about just good old-fashioned investing for free cash flow. Free cash flow. It's a proven measurement of quality beyond the shadow of a doubt. I mean, for most investors, the goal is we all just want to achieve financial security. And high free cash flow is absolutely an indicator of a company's financial strength, because positive free cash flow indicates a company is generating more cash than it needs to run the business and can invest in growth opportunities. And companies generating high free cash flow have the ability to grow their dividends over time and produce potentially better earnings. So if you want to get involved and use strategies that invest in great companies of America, I think it is so important that your investment advisor pays attention to free cash flow as a litmus test, as a valuation metric of what to own over time, because history has proven itself that those companies that generate tremendous free cash flow, which is a proven measurement of quality, are a good place for those who want to get retired and stay retired. And if you want to learn more about what those company names might be, because you look at this market condition, you look at this 10% correction that we've had, and you say to yourself, this too shall pass, then you're going to want to be a buyer of the dip. And if you're going to want to be a buyer of the dip, and not enough of your portfolio is in companies that raise their dividend every year from the high free cash flow that they have, you might be missing out. And I'd love to share with you how we do that, and we do that well at VestGen Wealth Partners. So what do you do? If you've been listening to us for years, heck, we've been on this show in this spot on Sundays for what now? 12, 13 years? Time flies. Lots of other people have come and go. We're still here because our message is consistent. We want to help you be an excellent steward of your family's finances by empowering you with education and allowing you to work with a fiduciary firm where you have access to an entire team, not a solo advisor with a couple of assistants, because that's not going to cut it. That's not good enough for those who want a family office experience of deeper conversations, of comprehensive services. 833-964-PLAN. Go out to our website, getretired, stayretired.com. Stay awesome, America.